Good morning, ARMR Insiders. Welcome to the morning meeting of the Virtual Hedge Fund, which we call the ARMR Investing Way. Take a long, hard look at that Dow Jones weekly chart pattern. We're going to go over it. It's going to be the lead of our discussion today. We're going to talk about the risk monitor, how things have changed in my portfolio. I'm going to share with you how I manage my own capital, as I always do, how I manage capital for investors. We're going to try to break it down in step by step. Big picture macro, how it changes our macro fund. Then we drop down to special situations fund, our swing trading type of portfolio with aggressive growth names. We'll talk about our ARMR Invest portfolio and how that's changed and what our cash position looks like. I'm going to go over all that with you. It's your job to take the information, look at your risk tolerance, your goal, what you're trying to do with your portfolio, make your own decisions, and be the smart money. Okay. Alert, alert, alert. The risk monitor has gone red. The noise around us has turned to a cacophony. We've had a great year. We're going into a period, in fact, we're already in it, of time where events are unfolding that affect markets that no algorithm is going to be able to help you with. So it comes down to, for me right now, a risk management decision. How much risk do I want to put into the capital markets in the world we live in right now? That's the decision for me. After looking at what has been a really great year, right? We made a lot of money, had a good year. Net worth is up everywhere. So between now and November, now and the end of the year, how much risk do I want to put on? What's the reward from here versus the risk I have to take? That's the number one question you have to be asking yourself. It's the question I'm asking myself. For my own capital, for capital that I manage, we say confluence is king. So let's start there. For weeks now, there has been no confluence. Big cap tech, which has been leading for a long time, has been reverting back to the mean at the very least. Maybe something more nefarious is unfolding. We don't know. But at the very least, it's reverting back to the mean, maybe the 50-day moving average, while other sectors of the market are trying to catch up. And so we have a non-confluence situation. So that's step one that makes me concerned. So we had risk monitor yellow for a few weeks. And then this is what really bothered me. Whenever we get a risk monitor green that flips red within a week or two, historically, for the ARMR Report, the capital that I'm managing and the risk monitor that I'm talking about, historically, when that happens, it's the most dangerous time for equities. Don't talk to me about what the market's doing Monday morning. Oh, the market's up Monday morning. That's got nothing to do with this conversation. Don't be so myopic. I'm not talking about day-to-day trading. Hey, the market could be up for a couple days. This is not what this conversation is about. I'm talking big picture. How much risk do I want to have on versus the reward I'm expecting from here? And what I'm saying to you this morning is the behavior of the risk monitor is at its most dangerous level. Think about the risk monitor November of last year. It flipped green. Every index looked exactly the same, which is the confluence I love. And we made a lot of money from that. That's risk monitor green. That's confluence. That's when rewards worth risk. So you put all the capital to work. What we've got up here is confusion, lack of confluence, markets going in opposite directions. That is typically the beginning of a very ugly period in the market. I always tell you, avoid the noise, okay? But it's a cacophony right now. We have an assassination attempt on Trump, and we have Joe Biden. I'm going to say something now, and I'm not a conspiracy theorist, okay? But we have the President of the United States announcing he's not going to run for re-election via a Twitter post, an X post. But let's take a look at some charts now. Here's the Dow, okay? Just a couple of risks. This is a weekly chart of the Dow. Couple of risk monitor reds. Risk monitor red back here in January 22. You can see what happened to the market. Risk monitor red right here. And I wanted to show you this because it doesn't always mean the market has to crash. It just means the reward from here wasn't worth it. There were a number of weeks. This is December 22. Then the market finally tried to break out here in July of 23. It was just an ugly kind of sideways market. And even that failed. And then the risk monitor green went there. We didn't get a risk monitor green here. It was just confusion. And then we got it here, led to our massive run. Every index went positive at the same time and looked exactly like this. That's the highest probability of making money when reward's worth risk. Where are we today? That's what we call in candlestick charting. I mean, this is literally classic right out of the textbooks of candlestick charting. This is a doji stone of epic proportion on a weekly chart. It's the last possible thing I wanted to see last week. We had a pennant breakout and then a doji stone week. It doesn't mean the market won't try to retrace that stone. It might. It might. But it tells you something's woefully wrong with that breakout. And when you look at where we are in the chart, totally stretched, that's the concern. The green to red is a concern. Let's go look at the equally weighted S&P. Okay. Same pennant breakout that looked really good to me a week before. Total doji stone reversal. It just doesn't get worse than that. Up here, total lack of confluence. And then let's just add a couple of very bizarre movements going on. Okay, something bizarre is going on in copper. We talked about it last week. Copper's just imploding. That's a weekly chart of copper as long as we're still on weekly.